It's no secret that the 2008 financial crisis was one of the worst economic disasters in recent history. But who is to blame? And more importantly, how did we let it happen? It's me. Welcome to my channel. In this video, we're going to try to answer the question, who shot first? An investigation into the causes of the 2008 financial crisis and the dominoes that led to its ultimate collapse. If you like stories like this, be sure to hit subscribe so you don't miss out on future episodes. Now, let's get back to our story. The year is 2007, and things are looking pretty bleak for homeowners across America. Housing prices have fallen nearly 10% in some markets, and experts are predicting a further decline. As people begin to default on their mortgages, there's a growing concern about who will be next. As the crisis reaches a fever pitch, all eyes turn towards a single investment bank, Lehman Brothers, which has been on the brink of bankruptcy for weeks. Finally, the firm files for Chapter 11, and the news sends shockwaves around the world. On a single day, the Dow Jones drops over 500 points, the largest single-day loss in its history. But while the immediate fallout from Lehman's collapse is devastating, hindsight suggests that this moment was not the start of the crisis, but rather its culmination. The real story of the financial crisis can be traced back years before, when housing prices were soaring and mortgages were being handed out like candy. So what went wrong? At the heart of the crisis lies the housing bubble, which saw prices double or even triple in some areas. But this rapid growth wasn't driven by genuine demand. Instead, it was fueled by cheap credit and speculation. Banks were eager to lend money to anyone who could make a down payment, regardless of their ability to pay it back. This practice is known as subprime lending, where lenders offer loans to borrowers with low credit scores who are considered risky. As a result, many homeowners took out mortgages they couldn't afford, hoping that prices would continue to rise so they could sell and make a profit. However, when interest rates increased, the housing market began to cool off, and those who had speculated on rising prices found themselves in negative equity, owing more on their mortgage than their house was worth. Eventually, this unsustainable situation collapsed, leaving millions of homeowners underwater on their mortgages and unable to sell. But what really caused this housing bubble? To understand that, we need to go back even further to the 1990s and 2000s, when government regulators began to loosen lending requirements. Prior to this time, banks were required to hold a certain percentage of the loans they issued in reserve to ensure that they would be able to pay out in the event of a default. But as the economy boomed and housing prices soared, regulators became more lenient, allowing banks to take on more risk. This created an environment where lenders were incentivized to offer mortgages to anyone who could breathe, leading to the subprime bubble that ultimately burst. So now that we understand the cause of the crisis, let's see how it spread and who profited from it along the way. The subprime bubble didn't just affect homeowners. In fact, it also caught the attention of Wall Street banks, who were looking for new ways to make money. With millions of Americans taking out mortgages they couldn't afford, banks began to realize there was a new product they could sell: bad debt. But how do you make money from selling bad debt? Well, the answer lies in a type of financial security called a collateralized debt obligation, or CDO. A CDO is a fancy way of saying that a bank bundles together a bunch of loans, typically subprime mortgages, and then sells them to investors as a single unit. This process allows banks to free up their capital and investors to buy a piece of the action without having to deal with individual borrowers. But here's the kicker. The problem with CDOs is that they are incredibly complex, making it difficult for investors to understand the risks involved. In fact, most CDOs are made up of a variety of different types of debt, including subprime mortgages, credit card debt, and auto loans. This makes it hard to predict how well the security will perform, since the underlying assets are so diverse. To make matters worse, CDOs are often rated by credit rating agencies like Moody's and Standard & Poor's. These agencies assign a letter grade to each security, indicating its level of risk. But in the case of CDOs, many of these ratings were inflated, giving investors a false sense of security. For example, one CDO might receive an AAA rating despite being made up entirely of subprime mortgages. That is, because the credit rating agencies were paid by the banks issuing the CDOs and had a vested interest in making them look good. This practice is known as rating shopping, where banks will shop around for the highest rating possible, even if it's not accurate. With misleading ratings and complex structures, CDOs were essentially a ticking time bomb waiting to explode. But the real disaster began when Lehman Brothers, one of the largest investment banks in the world, collapsed. On September 15, 2008, Lehman Brothers filed for bankruptcy, marking the largest bankruptcy in U.S. history. The news sent shockwaves throughout the financial system as investors began to worry that they would get their money back. After all, Lehman had been one of the largest and most respected investment banks in the world. But Lehman's collapse didn't just affect its investors. It also sparked a panic among banks and other financial institutions that held Suddenly, everyone was worried about the value of their investments and the safety of their money. As people rushed to withdraw their money from banks, many found that their cash was gone. Some banks had invested their customers' money in CDOs, and when those investments failed, customers lost everything. This created a run on the banks, with people withdrawing their money as fast as they could. But unfortunately, many banks didn't have enough cash on hand to satisfy everyone. So they began to fail left and right. Soon, the entire financial system was at risk of collapse. If you want to know more about this period, check out our series on the Great Recession. We cover how countries around the world were impacted by the crisis, the role of government bailouts, and the lasting effects that the recession had on our economies. As the financial system teetered on the edge of disaster, governments around the world sprang into action. They bailed out banks, passed stimulus packages, and cut interest rates to try to prevent a total collapse. In the United States, the government bailed out a major insurance company that had invested heavily in CDOs and was on the brink of collapse. But perhaps the most controversial bailout was the $700 billion Troubled Asset Relief Program, or TARP, which was designed to purchase bad debt from banks and stabilize the financial system. While the program was ultimately successful in preventing a complete meltdown, it was widely seen as unfair since taxpayers were on the hook for the losses of banks and other financial institutions. In the end, the financial crisis resulted in a number of far-reaching consequences. Millions of people lost their homes and their life savings. The U.S. economy fell into a deep recession, and the world was plunged into uncertainty. The crisis also highlighted the dangers of unregulated markets and the importance of government oversight. Many of the practices that led to the crisis, such as rating, shopping, and subprime lending, were made possible by a lack of regulation and oversight. As a result, calls for greater transparency and accountability grew louder. But it wasn't just the government that was to blame. Banks, credit rating agencies, and other financial institutions also played a role in the crisis. Banks took on excessive risk and engaged in shady lending practices, while credit rating agencies failed to accurately assess the risk of But despite the finger-pointing, the fact remains that the crisis was a result of a perfect storm of bad decisions, risky investments, and a lack of oversight. And while it's easy to point the finger at one institution or another, the reality is that we all played a role in creating the conditions that led to the crisis. As we look back on the financial crisis of 2008, we must remember the lessons of the past and work to prevent a repeat of such a devastating event. We must demand greater accountability and transparency from financial institutions, push for stronger government regulation, and make sure that those responsible for the crisis are held to account. Only then can we hope to prevent such a catastrophe from happening again. So who was to blame for the financial crisis? The simple answer is all of us. From the banks to the credit rating agencies to the government, we all played a role in creating the conditions that led to the crisis. But while the crisis was the result of a perfect storm of events, we can take steps to make sure that such a disaster never happens again. By demanding greater accountability and transparency, pushing for stronger regulation, and holding those responsible to account, we can work together to prevent a repeat of the financial crisis. We hope that this video has given you a better understanding of the causes of the 2008 financial crisis and the factors that led to its collapse. If you enjoyed this video, be sure to give it a thumbs up and leave a comment below to let us know what you thought. And don't forget to subscribe so you don't miss out on any of our future episodes. Thanks for watching.